Happy Wednesday out there, folks. This is Darius Dale here to present our macro minute for Wednesday, July 6, 2022. Starting with asset markets, we have stocks mixed this morning with Europe leading, commodities mixed with ag leading, crypto down, dollar up, global bond yields down. Market moving headlines, we have China backsliding on COVID. So Beijing residents wanting to enter a raft of public spaces will need to show proof of vaccination from Monday, the first time China has deployed a vaccine mandate. Shanghai's mass testing again in 10 of their 16 provinces, sparking concern of another lockdown. Macau shut the Grand Lisboa casino after 13 cases were linked to the resort. Hong Kong health officials said they're concerned the outbreak is worsening, and probably the worst news of it all as it relates to China's zero COVID is we now have an outbreak of Omicron in the Western region. So we'll keep our eyes on that, keep tracking on that. Talked about China, really went into detail on China, how to risk manage China over the medium term with respect to China's zero COVID policy. And sort of the expectations therein. Shifting gears, stop reading the tea leaves and just drink the damn tea. So everyone's going to be paying attention to these Fed minutes. They may shed light on whether we'll get another supersized 75 basis point rate hike this month. Bloomberg Economics expects discussions to show that June's bazooka were triggered by concerned consumer inflation expectations weren't anchoring, helping to explain the FOMC's focus on headline rather than core price gauges. The minutes may also provide insights into how officials would view a decline in economic activity. None of that matters. The only thing that matters is getting inflation expectations back anchored and making sure that reported inflation is very much exhibiting clear and confirming evidence of returning back to the Fed's 2% target. The Fed has a singular mandate. They will not abandon the singular mandate until the singular mandate is achieved. And one thing I will call out on that is I think the market is still in this process of sort of pricing in or out incremental tightening as if sort of there's this sort of spectrum on Fed activity. But the reality is the Fed is operating under a sort of signal-based framework, which is we're waiting to achieve the signal in order to do something different, as opposed to incrementally doing something different along the way to achieving the signal. So that, in my opinion, is not as it's a less positive outcome for asset markets. And I think what we saw yesterday afternoon on the decline in crude oil, which itself may be pricing out of the China reopening narrative from the China reopening premium from commodity markets, pricing that out of commodity markets. Certainly our analysis would continue to suggest that we have not even come close to pricing in a hashtag actual recession. And then lastly, forward guidance speeds up the monetary policy transmission mechanism. This is something we've talked about all year in our macro scouting report presentations. In terms of, the Fed's effectively talked us into a slowdown. They barely hiked rates. We're only at 175 on the Fed funds rate, but the asset markets are reacting to as if they've priced in, 400 basis points of hiking and obviously a significant degree of quantitative tightening. And that's just really the power of the Fed's words. So you have global corporate debt shrinking for the first time in 8 years. Global corporate debt shrinking for the first time in 8 years. That should really get your spidey senses tingling as soaring financing costs and rising recession angst. You have Janus and Henderson Index showing a drop of 2% in net debt in the year ending in March. You can't grow the global U.S. or global economy without expanding the outstanding debt stock for either the private sector or the public sector or both. So shrinking corporate debt is one of these sort of pre-recessionary signals that you're starting to get to a place that's very late in the broader economic cycle. And, looking at places like Europe, you may very well already be in recession there, at least at the early part of that process. Big movers. Shanghai Composite off 1.4%. That's the largest decline since late May on this COVID outbreak news. And it's still up 3.7% month over month. I had a great discussion with one of our Protopole subscribers, brilliant guy, sort of Chinese descent. And he sort of said, hey, look, I think situation the CIC is over there buying Chinese stocks. And I said, you know what, good. We're long them and strong them. I want them to buy more of them. Who cares if it's the economy that causes them to go up or the government that causes them to go up? What we care about is them going up as long as we're along them. And then Euro USD minus 0.8% to off 4.7% month over month. So this euro move towards parity, potentially through parity, is really accelerating. This is something we called out in our leadoff morning note very explicitly going back a few weeks. Said if we watch that euro Swiss franc cross, if we could break parity there, we're going to break parity in the US dollar. And so we were keen to I'll leave it at that. Leave it at that for out of respect for our paying subscribers. And then lastly, US dollar 5-year forward inflation swap rate down 10 basis points to off 39 basis points month over month. That's a pretty significant signal to the Fed that they're really starting to keep longer term inflation expectations anchor. We still have not achieved Powell's objectives. If you look at the real yield curve analysis that we've produced, or the getting consumer inflation expectations, 5 to 10 year inflation expectations in the UMetch survey back to target. But we're certainly, obviously with this move in commodity markets, probably moving in the right direction, as evidenced again by the inflation swap rate. Transitioning to our volatility adjusted momentum signals and probable ranges. US dollar, that's bullish VAMs, not quite overbought, but getting there, only 0.3% of upside versus 2.3% of downside. Gold, bearish VAMs, that is oversold. 10-year nominal treasury yield, bullish VAMs, that is oversold, has been for a while now, really hugging that lower boundary of the probable range, maybe a leading indicator of a phase transition there. In the VAM signal, high yield credit spreads, that's bullish VAMs in the middle of its range. You got S&P 500, that's bearish VAMs. You got 1.7% of downside versus 6.6% of upside. So not a great setup there to be chasing risk. VIX neutral VAMs in the middle of its range still. NASDAQ 100, still not a even worse setup to be chasing risk in NASDAQ names. One is 8.4% of downside versus only 1.8% of upside. Russell 2000 bearish VAMs, similar setup to the NASDAQ, 1.6% of upside versus 8.2% of downside. Bitcoin bearish VAMs still. Kind of 2-to-1 downside, 6% upside, 12% of downside. Ethereum bearish VAMs, almost 3-to-1 downside, 18% of downside versus 7% of upside. Now, Shanghai Composite, that is bullish VAMs. Finally a fair fight here. If you haven't been able to get long with China, again, admittedly, the fundamental outlook is definitely worse at the margin, given President Xi's renewed commitment to zero COVID. He made some pretty very strong comments, towards the end of last week in support of zero COVID. And then now you have the outbreaks rising. You can sort of put 2 and 2 together there. But again, don't care if it's CIC or the economy. This thing is obviously trending higher. It is bullish VAMs. That is a nascent signal. What we like, 42 macro, are nascent signals. What you don't like are latent signals, because those are the ones that get you beat up in the phase transitions. Anyway, 1.6% of downside versus 3.5% of upside. WTI crude oil still obviously oversold here. We talked about that in a leadoff morning note in terms of what to do from a tactical perspective here. So go check that out if you haven't seen it. Agriculture bearish VAMs, same deal there. Deeply oversold. Industrial metals bearish VAMs, deeply oversold, has been for a while. So you have two things. The market took this and ran with it, saying, "Hey, look, we're fully pricing in the recession," which means the Fed's going to be able to pivot. We continue to be very much on the other side of that view. We think what's really happening in commodity markets is this sort of China premium being priced out. We certainly have not, at least according to our compendium of indicators, have seen a full actual recession priced into asset markets. And until we do that, we're not going to be able to truly buy the dip with any conviction or any real size, because again, the markets have to price in that outcome if it occurs. Cheers.